first of all, the introduction. So, according to the Banking Regulation Act 1949, there are two things, that one is Reserve Bank of Indian Act 1934, and one is Banking Regulation Act, that is 1949. So, the whole banking system in India is covered by these two main legislations. So, the focus of the governance is to ensure sound banking through a regulation covering the opening of branches and maintenance of liquid asset. So the corporate bodies doing the banking business in India is required to follow the provisions of the Banking Act. Before 1949, there was a special law to regulate banking companies further. The banking companies are also subject to Companies Act 2013 or 1956. As we all know that the Companies Act 2013 is in the main thing, right, nowadays. So the provision of the Banking Regulation Act are in addition to the company law. If there is some specific law for a particular business, it will be largely governed by the specific act, but the other basic laws will also be applicable to the business. So as similar to banking, there are separate acts for insurance business, electricity companies. Most of the business is run by the corporate bodies, so the corporate law is compulsorily relevant for them. Now we're going to discuss about the banking companies. So basically the banking companies is having two words, one is banking and one is company. So the definition, we need to learn both the definitions. So the definition is given in section 5 of this particular act. First we need to discuss about the banking. Banking means the accepting for the purpose of lending or investing of deposits of money from the public repayable on demand or otherwise, and withdrawal by check, draft, order form or otherwise. Then banking company means any company which transact the business of banking in India. Then we need to discuss about the licensing of banking companies. So basically in India there is no company can carry on banking business unless it holds a license issued from RBI, and such license may be issued subject to certain conditions as the RBI may think fit to impose in the case. So before granting a license to the company, the RBI may require to be satisfied by the inspection of the books of the company. So here we have some conditions that we need to fulfill strictly to take the license for a banking company. So first of all, the company is or will be in a position to pay its present or future depositors in full as their claims accrue. Second one is the affairs of the company are not being conducted in a manner detrimental to the interest of its present or future depositors. Third one is the general character of the proposed management of the company will not be prejudicial to the public interest or the interest of the depository. Fourth one is the company has adequate capital structure and earning prospects. The public interest will be served by the grant of a license to the company to carry on banking business in India. Then the grant of license would be suitable for the monetary stability and economic growth of the area of operation of the company, and the potential scope for expansion of banks already in existence in the area and other relevant factors would be examined before issuance of the license. So and any other additional condition whichever is considered fit to be imposed by the RBI for carrying on business, that one is banking business. So here we have the forms of business of banking companies. First one, the borrowing, raising or taking up of money, the lending or advancing of money. Second one is the drawing, making, accepting, discounting, buying, selling, collecting, dealing in bill of exchange, hundis, promissory notes, coupons, drafts, bills of lading, railway receipt, warrants, debentures, certificates, scripts, and other instruments and securities. That particular thing, the granting and issuing of letter of credit, traveler check, and circular notes. Next one is the buying and selling and dealing in bullion and specie. Next one is the buying and selling of foreign exchange, including foreign banking notes. Next one is the acquiring, holding, issuing on commission, underwriting, dealing in stock funds, shares, debentures, debenture stock, bonds, obligations, securities, and investment of all kinds. Then the purchasing and selling of bonds, scrips, or other forms of securities on behalf of constituents or others, the negotiating of loans and advances. Next one is the receiving of all kinds of bond, scrips, or valuable on deposit or for safe custody or otherwise the providing of safe deposit vaults. Next one is the collecting and transmitting of money and securities. Next is the acting as an attorney on behalf of customer. So like these we have multiple guidelines which you need to read out at your home, because if you are not following these guidelines you are not able to take the license of a banking company. Next point comes under the disposal of non-banking asset. So basically non-banking asset, we need to basically dispose the assets which are considered as a non-banking asset. So there is no banking company can directly or indirectly deal in buying and selling or bartering of goods except in connection with realization of security given or held by it. So basically in the case of failure on part of borrower or to repay the loans, the bank may have to take possession of such assets. So in that particular case, the asset will be shown in the balance sheet as non-banking asset, and these assets must be disposed of in maximum 7 years. The banking company may within the period of 7 years deal or trade in such property for the purpose of facilitating the disposal thereof, and the duration of 7 years may be further extended by the RBI up to the maximum 5 years, where the RBI is satisfied that such extension would be in the interest of the depositor of the banking company. Next one is the slip system of ledger posting. So in this particular system, posting is made from slips prepared inside the organization itself or slip filled by the customer. The slip system is a method of rapid posting in books maintained under double entry principle. And in this particular system, posting is done from slips and not from journals or cash book, and the subsidiary books are not maintained in the system, and the slips are loose leaves and they are given by the customer or by the bank staff. In the banking company, the main slips are pay in slip, withdrawal slip, checks, and all these slips are filled by client of the bank. So the original checks and pay in slips are used as voucher. The transaction which are not covered by original slips are posted by mean of doc and which are made out by the bank staff or bank staff. These are used for posting purposes basically, and in that particular posting purposes in the banking system in which we are having quickly, and we need to follow or introduce the CBS accounting. So the optimum speed in ledger posting is warranted and it is easily done through the software. So we have the advantages of slip systems and we have the disadvantages of slip system. So basically first of all we need to discuss about the advantages of slip systems. First one is to reduce the possibility of errors. Second one is to mitigate the chances of frauds. Third one is to save a lot of time since slips are prepared by the customers themselves. Then it provide an efficient system of internal check and later in audit work. ये नहीं पता था ये है दूसरी बात ये फोन में क्या दिखा रहा है So next one is the disadvantages of a slip system. Next one is the disadvantages of slip system. So there is a basically risk of loss of a slip since they are loose. And the second one is there is a chance of misappropriation and destruction because they can be easily changed or removed. So in the branch where the number of transaction is high, it becomes difficult to handle them and keep preserved in a systematic manner. Here we have the debit voucher. Basically, it shows the received amount and the affix revenue thing. Second thing in messenger Swaminathan traders, for example, and we have the address, date, voucher number. And in this particular thing we have the wages thing particularly, so we will show the amount according, and in the bottom side we need to get signed it from the accountant. तू तो 2 घंटे लगा देंगे, बस तो फिर नहीं लगेंगे, और मैं समोसा मंगाऊंगी तेरे लिए। ठीक है, बाय, मिलते हैं 4 बजे 5 बजे। Next one is bank teller system. So in the bank teller system, it is an integrated hardware and software that is used for retail or wholesale banking transaction. So the most of the system communicate with the core banking system or mainframe over a secure network. It is actually used in order to improve services and productivity. In the bank teller system with advanced architecture that will be design concept in trouble free and user friendly interface, and the system has high degree of integration, compatibility, expensibility expansionability to meet the requirement of the counter system functions and performance of the banking business development. It also provides the strong system support for banking development and banking or business integration. So this particular hardware commonly used in bank teller system are computer or terminal, cash drawers, receipt, passbook validators, printers, magnetic strip reader, pin keypads, bill counters, and bill coin dispensers. So basically, the software is usually based on client server where several clients like teller stations are networked to a server which communicates to the mainframe via a dedicated line or satellite. Next one is the objective of a bank teller system. So basically, it integrates the front end operation to improve service efficiency, business process reengineering, and business product innovation, improve user experience and promote product sale, control business risk and promote bank process, system portal services, uniform management, and customer services that is oriented business process re-engineering. Here we have some areas of bank teller system like core banking, bank supervision report, infrastructure platform, credit card risk management, known bank service, credit risk management, financially management, treasury, bank marketing, insurance services. Now we have the structure of balance sheet and profit and loss account of banking companies. According to Section 29 of the Banking Regulation Act 1949, a banking company is required to prepare its balance sheet and profit and loss account in the form set out in the Schedule 3rd of the Act. So the basically formats are given below as specified in Banking Regulation Act in Form A of balance sheet and Form B of P&L account, and 16 schedules for details of a related items. So basically, in addition to these schedules, banks may prepare Schedule 17 for notes on account and Schedule 18 for disclosure of accounting policies. Here we have the format of a particular balance sheet which we have already discussed in our previous lectures. You can go through these whole basically format of a P&L and balance sheet at your home, because we have already discussed about it. Now the point is non banking financial company. So basically a non banking financial company is a company that is registered under the Company Act 1956 or 2013 and is engaged in the business of loans and advances, acquisition of shares, stock, bonds, debentures, securities that will be issued by government or local authorities, other marketable securities, leasing, hire purchase, insurance, chit funds, or chit businesses, we can say. And it is mandatory that every non banking financial corporation or company should be registered with RBI to commence or carry on any business of non banking financial institution. But certain categories of NBFC which are regulated by other regulator are exempted from the requirement of resignation or registration with RBI. Sorry, requirement of registration with RBI. And a merchant banking company or a venture capital fund or a stock broking company will be registered with SEBI. The housing finance companies are regulated by the non housing bank. Here we have the asset finance company, investment company, and loan company. So basically, in the asset finance company, it is defined as any company which is financial institution carrying on as its principal business the financing of physical assets supporting productive economic activities such as automobiles, tractors, lathe machines, generator set, earth moving and material handling. Give me 2 minutes.
थर्ड लाइन है, लास्ट लाइन, उसमें ना
So
NABF की इशू
basically,
लिखा है, उसमें
asset
आपको
financing
देखना है।
company that is defined as any company which is financial institution carrying on as its principal business the financial of physical asset supporting productive economic activity. And then the principal business of this purpose is defined as aggregate of financing real physical asset that is supporting economic activity and income arising therefrom is not less than 60% of it total asset and total income that is respectively. So basically asset financing company are further classified into those accepting deposit and those not accepting deposit. Then we have a topic of residuary non-banking company. That particular company are also registered as NBFC with the RBI, and residuary non-banking company is a class of NBMC which is a company and has as its principal business that is receiving of deposits under any scheme of arrangement in any other and not being investment asset financing loan company. So basically these prudential norms directions are applicable to these companies to ensure the interest of depositories such as companies that are required to invest in a portfolio comprising of highly liquid and secured instruments. Here we have the difference between NBFC and banks, which you can read at your home. Then there is a depository concern and NBFC regulations. So basically NBFC are allowed to accept public deposit for a minimum of 12 months and maximum period of 60 months, and they cannot accept deposit that are repayable in demand. So the NBFC cannot offer interest rate higher than the ceiling rate that is prescribed by RBI from time to time. So the present ceiling is 12.5% per annum. Next one is NBFC cannot offer gifts, incentive, or any other additional benefit to the depositors. Then the deposit with NBFC cannot be insured. The repayment of deposit of NBFC is not guaranteed by the RBI. There are certain mandatory disclosure about the company in a application form that are issued by the company soliciting deposits. And if the company defaults in repayment of deposit, so the depositor can approach company law board or consumer forum or file a civil suit to recover the deposit. And in the case of a complaint against the NBFC, the depositor can mail an application in prescribed form to the appropriate bench of the company law board according to its territorial jurisdiction with the prescribed fees. Now there are periodical returns to be submitted to RBI. So the prescribed guidelines are to be followed by NBFC. They are on income recognition, asset classification, provisioning requirements, that is, exposure norms, constituents of audit committee, disclosure in the balance sheet, requirement of capital adequacy, restrictions on investment in land and building, and unquoted shares. So, the control mechanism of the regulator works through periodical return. So now we have some public depositors in which the requirement are needed to furnish to RBI. First of all, the audited final accounts, the copy of the audit of report need to be furnished to RBI. Then statutory annual report on deposits, certificate from the auditor, quarterly return on liquid asset, uh, half yearly return on prudential norms, half yearly ALM returns by companies having public deposit of 20 crore and above or with asset of 10 crore above, irrespective of the size of deposit, monthly return on exposure of capital market by companies having public deposit of rupees 50 crore and above, a copy of the credit rating obtained once a year. Then we have the balance sheet of NBFCs. Like this, you can see it is same as the NBFC or any other balance sheet which will be shown to you Then the next topic is for stock invest scheme.
4.4 में एक करेक्शन था, 15-14 पे देरी लगा।
Next one is a stock invest scheme. There was a large number of complaints regarding non-receipt or delayed refund of share application money. So the SEBI advanced a suggestion in this regard, and a new instrument was introduced by the SBI. So the instrument is stock invest, and it is approved by the RBI. An investor who has an account for a deposit with the bank issuing stock invest will apply for stock invest. So the issuing bank will give the stock invest duly signed and also marking the date to the investor. Now we have the features of stock invest instrument. Stock invest is a special payment system for investor in the primary capital market. Stock invest instrument is approved by the RBI for public issue of shares or debentures. The stock invest is a letter of authority come check which the payee can encash for authorized sum based on actual allotment made to the investor. All individuals can seek issue of stock investment against deposit held by them in their bank account. Stock invest is valid for a period of 4 months. Stock invest is payable at par at all the branches of the bank. Once the basis of allotment is decided, stock invest of successful allottee is encashed. Stock invest instruments of unsuccessful applicant is returned without encashing it. Money received on encashment would be kept in separate account where the company would also deposit the cash and other money by way of check, banks and etc. No allotment is made to any investor unless the minimum subscription is received. The above provision would be required to be completed within the stipulated time as per company law. Next, the stock invest is issued after a lien in is marked for appropriate amount on the deposit account of the investor, but the deposit will continue to accrue interest at the agreed rate till the instrument is actually to be debited, and the banker lien on the investor deposit account would be automatically lifted when a valid instrument is presented after allotment. And the cancelled stock invest is surrendered by the investor. Here we have the revision of a stock investment scheme. Basically, the scrutiny of the stock invest operation scheme conducted by the RBI that is revealed under certain shortcomings comings of the scheme. In the starting the scheme, the stock investment were issued in blank and the particulars of the public issue were to be filled in by the investor thereon. RBI also issued revised instruction modifying the scheme. Basically, the bank will not issue the stock invest in blank, but the details of the public issue will be given compulsory on it. And the bank should henceforth fill in the name of the capital issuing company before the stock invest are delivered to the applicant. Next one is the consultation with SBI. RBI prescribed a ceiling of rupees 10 lakh per individual per capital issue for stock invest issued by bank. The ceiling is not applicable for mutual funds. Now we have the performa of the stock investment. Like this, we can see the stock invest performa. In this particular, we have the pay account only, that is not negotiable. Then to which bank we are basically mentioning it, then the date of the issue, then the declaration from the bank point of view and from the pay bank point of view, then serial number of check with code, then bank code, and then there is a authorized signatory pay signatures account. Here we have the some terms of issue and payment of a stock investment. These are the basic investment basically which it is issued to the applicant to be used for applying new issues of shares, debentures, bonds only. Then the applicant will authorize payment of the maximum sum payable towards application money for the share, debentures, bonds applied on the left hand side of the stock investment. Then stock investment is paid to the pay filling in the required particulars on the right side under due authorization and discharged by their authorized signatory and presenting it for payment. Next one is stock investor is neither transferable nor negotiable. The issuing bank undertakes to pay the lower of the two sums indicated on the face of the instrument. Then stock invest is currently for 4 months from the date of its issue indicated on its face. Then stock invest is payable at all branches of the issuing bank and where the correspondent arrangement is done by the bank. Then bank account holder instruction in respect of stock invest to the bank is irrevocable. Then the investor shall provide details such as pay name basically. Next one is the investor should not hand over the stock invest taken against their own account to any third party, and the registrar to the issue will return stock invest duly cancelled to the unsuccessful applicant. Accordingly, on production of the cancelled stock invest by the applicant, the issuing bank shall lift the lien immediately. So basically, this is our 16th unit, which we covered basically.
हो जाता है कोई बात नहीं.
So basically, next unit we have the account of banking companies, that we need to see the accounting treatment of banking companies. In this particular thing, we need to prepare the books of account of banking company, discuss the provision that is pertaining to accounting of banking companies. Then we need to prepare the P&L account of banking companies, and we need to prepare the balance sheet of banking or bank companies. So basically, first of all, we need to see the minimum capital and reserve that comes under section 11 of the act, that lays down the minimum limit of paid up capital and reserve. Like banking company incorporated in India having business offices in more than one state except Mumbai and Kolkata, so the capital reserve will be paid up capital and total reserve will be 5 lakh. Next one is a banking company incorporated in India having business offices in more than one state and having business offices in Mumbai or Kolkata or both. That will the limit of rupees 10 lakh. Then any other office is in Mumbai or Kolkata for every business office that is situated at the place other than Mumbai or Kolkata. Additional capital of 25,000 should be, they are limited to the maximum of 10 lakh, that will be 5 lakh. If business office is in the state not in Mumbai or Kolkata, for every additional office in the same district, that is 10,000, and for every office situated in other district, that will be 25,000. But paid up capital and reserve of such bank need not be more than 5 lakh, that is 1 lakh. Next one is the bank that is incorporated outside India. If they do not have any business office in Mumbai or Kolkata, that will be 15 lakh. And if they have business office in Mumbai or Kolkata or in both, that will be 20 lakh. So, banking companies carrying on business in India must see to it that the subscribed capital is not less than half of the authorized capital. The paid up capital is not less than half of the subscribed capital, and the capital of the company that consists of only or ordinary or equity shares. So basically, the underwriting commission or brokerage or discount on shares issued by the banking company cannot exceed 2.5% of the paid up value of the share, and a charge on unpaid capital cannot be treated. So, no dividend can be declared unless expense or not represented by tangible asset have been completely written off. So, basically, now we can see the books of account, that is the cash book, then cash balance, day book, current account ledger, saving bank ledger, fixed deposit ledger, general ledger. Then we have the registers like bill for collection register, security register, document register, standing order register, check dishonor register, draft issue register, draft payable register, DD register, then foreign letter of credit register. Then we have some important terms like statutory reserve, that is reserve under Section 17 of the Banking Regulation Act. It is the obligation for the banking company operation in India to create a reserve fund and transfer to it at least 25% of its profit as disclosed in the P&L account before any dividend is declared. After that, we have the unexpired rebate on bills of discounted. So basically, the amount of discount on bill discounted is to be credited to discount received account. Next one is customer acceptance and endorsement. In that particular thing, there is a credit of a bank is more acceptable than that of its customer. Hence, a bank is often requested by a customer to accept or endorse a bill of exchange on his behalf or give a guarantee of repayment of a loan that will be raised by the customer. Then the bills of exchange for collection. A bank receive a large number of bill receivable from its customer for collection on the due date of the bill. So the bank keeps these bills with itself till maturity, and on realization there is a credit the amount to the client that is concerned. Next one is the restrictions on loan advances. We have different provision like on the security of its own shares to any of its director to any firm in which they in which any of its director is interested as partner, manager, or guarantor. Then next one is to any company of which any of its director is director, manager, employee, guarantor, or in which he holds substantial interest. Next one is to any individual in respect of whom any of its director is a partner or guarantor. Then we have some kind of CRR, SLR, repo rate, and reserve repo rate. CRR is the cash reserve ratio. SLR is the statutory reserve ratio. Basically, these are the ratios which affect the inflation or deflation. That means these are the interest rate which can goes up or down as per the instruction of the RBI, because RBI needs to control the inflation or deflation rate. That will be that RBI needs to maintain a stable rate in the market, so he can reduce or increase these kind of rates in the market. Next one is P&L account, balance sheet, and of banking companies. Basically, each and every banking company is required to prepare its annual account in accordance with the section 29 of the Banking Regulation Act. So each and every company will prepare the balance sheet and P&L account as the same way the a particular normal company will make it. We have the illustration also which you can solve it at your home. You just need to prepare the P&L account which we have already discussed in our last sessions. Here you have the illustrations.
चला रहा था इसके तो मेरी क्लास में से नेटवर्क निकाल
So these are the illustration which you need to solve it at your home from this particular unit. So now we will discuss our next unit. That will be our 18th unit. And the name of this particular unit is commercial bank. So in this particular unit, we need to know the meaning of commercial bank, functions of commercial bank. Then we need to describe the structure of Indian commercial bank, need to identify various sources of funds of commercial banks. Then we need to know the various investment norms followed by commercial bank, and need to analyze the asset structure of commercial banks. So in the introduction, commercial bank represent the latest group of depository institution that will be measured by asset size, and they perform the functions similar to those of saving institutions and credit unions. So basically, commercial banks in India is a unique system, and the like of which exists now here in the world. The banking system in India works under the constraints that go with social control and public ownership. And it can say that commercial bank is a financial institution which perform the functions of accepting deposit from the general public and also giving loans for investment with the aim of earning profit. Then commercial banks generally finance trade and commerce with short term loans, and most of the Indian stock joint stock banks are commercial banks such as Punjab National Bank, Allahabad Bank, Canara Bank, Andhra Bank, Bank of Baroda. So first of all, we need to know the meaning. So the commercial banks are the simple business or commercial concern which provides various types of financial services to customers in return of payment in the form of interest, discount, fees, commission, and so on. And basically the objective of these banks is to make profits, and however the degree of which they have to balance the principle of profit maximization with certain other principles like principle of social welfare, social justice, promotion of regional balance in development that distinguish these banks from the other business concern. So basically, commercial bank gives loan to non-financial banking, and non-financial firms will give the deposit.
मैंने ही स्टार्ट कर दिया।
So basically, in Indian banking system, that will be consist of the RBI, commercial banks, and cooperative banks. So the major principle which bank strive to incorporate in their workings are profitability, liquidity, safety, and social welfare. And the finally, commercial banks offer maturity intermediation services to the economy. And in the other word, it can be said that the commercial bank is a financial institution which performs the functions of accepting deposit from the general public and giving loans for investment with the aim of earning profit. So here we have the significance of commercial banks is they are given below that they promote savings and accelerate the rate of capital formation. They are source of finance and credit of trade and industry of a country. Then they promote balanced regional development by opening balance branches in backward and remote areas of a country. Then the bank credit enables entrepreneurs to innovate and invest in the large and small scale industries, which accelerate the process of economic development of a country. Then they help in encouraging large scale production and growth of priority sectors such as agriculture, small scale industry, retail trade, and export. Then they also help commerce and industry of a country to expand their field of operations. Here you have the basic commercial banks total balance sheet for each and everything. Now we have the functions of commercial banks. So the functions are, the first one is the primary function, and the primary function consists the acceptance of deposit like current account deposits, fixed deposits like time deposit. Then we have the saving account deposit. Second one is giving loans and advances like cash credits, demand loans, and short term loans. Then we have the secondary functions like discounting bill of exchange. Then we have credit creation, financing for foreign trade, overdraft facility, then agency functions of the bank. Then we have the collection and transfer of funds like payments of various items, purchase and sale of shares and securities, collection of dividends and interest, then letters of references. Then we have general utility services like the customer can keep their ornaments and important documents in lockers for safe custody. Then it also provides the facility of underwriting security issued by government, public or private bodies, and the banker issue traveler check and gift check to its customer. So basically,
अच्छी लग रही है।
Now we have the topic of structure of Indian commercial banks. Indian commercial bank consists of scheduled banks. It comes with the public sector bank, private sector bank, and foreign bank. Second one is non-scheduled bank. So basically, in the scheduled bank, these are the banks which have been included in the second schedule of the Reserve Bank of India Act 1934. And in India, scheduled commercial banks are of basically three types, which I already told you, that one is public sector, private sector, and foreign banks. Next one is non-scheduled banks. Non-scheduled banks are those banks which are not included in the second schedule of the Reserve Bank of India Act 1934. Now we have the sources of fund for the banks. First source of fund is actually the deposit, which are commercial banks received from the public. Then second one is reserve fund like CRR, SLR, which is uh, told or instructions given by the RBI. Then each and every bank have some kind of retained earning. Then shareholders capital, then borrowings from other banks also are the source of the funds of the commercial banks. So here we have a table which shows the aggregate deposit and bank credit of scheduled commercial banks. And like you can see the ownership of deposit with scheduled commercial bank, bank groups, etc. Now we have the point of investment norms. So the Reserve Bank of India issues guidelines for the investment portfolio of the banks, keeping in view the development in the financial market and taking into consideration the evolving international practices. It is also directed by the RBI that banks should frame internal investment policy guideline and obtain the board approval. The investment policy may be suitably framed, amended to include primary dealer activities also. It is also suggested by the central bank that the investor policy guidelines should be implemented to ensure that operation and securities are conducted in accordance with sound and acceptable business practices. RBI also told that the bank successfully in the auction of primary issue of government security may enter into the contract for sale of the allotted securities in accordance with the terms and conditions. Those are mentioned in the respective annexure. And the entire investment portfolio of the bank, including SLR and non SLR securities, should be classified under the three categories, that is, held to maturity, available for sale, held for trading. And however, in the balance sheet, the investment will be disclosed as per the existing six classification. First one is government security, second one is approved security, then shares, debentures, and bond, subsidiary, joint ventures, and last one is others, and it consists of commercial paper, mutual fund units, etc. Next is asset structure of commercial banks. So basically, the balance sheet of a bank is of great importance to know the sources and uses of its funds. It is well known that the balance sheet of an institution that indicates its liability and asset. So the liability of a bank show the source of its fund, and assets show it uses by it. Commercial banks use their funds primarily to purchase income earning asset, mainly loans and investment. Asset structure will reflect the deployment of sources of funds of commercial bank, and the main sources of fund of commercial banks is deposit, and the other sources of funds are borrowing from other banks, capital reserve, and surplus. And the deposit of commercial banks are from saving deposit, current account deposit, and term deposit.
Pardon. गया हूँ मैं।
So basically, here we have some bank assets which we need to examine. That first point is, for the asset, the most important thing is cash in hand. Second one is money at call or short notice, that money lent by the banks to other banks, that like bill brokers, discount houses and other financial institution, for a very short period of time varying from 1 to 14 days. When these funds are repayable on demand without prior notice, it is called money at call. And on the other hand, if some prior notice is required, it is known as money short notice. Next one is investment. Investment constitutes one of the important asset of the bank next to loans and advances. So basically, a bank makes investment for the purpose of earning profits. Commercial banks use funds for investment in various types of securities like gilt-edged securities of the central and the state government, as well as shares and debentures of corporate undertaking. Next one is loans and advances. So basically, the interest earned from these assets generate the bulk of commercial bank revenues. So the commercial banking industry in India has been playing a very important role in intermediating between the economic units. Next one is fixed asset. As we all know that the fixed asset do not form an important aspect in the funds of commercial bank, since it deals are more in financial asset than the real assets. Next one is other asset. These include the physical asset of a bank, like the bank premises, furniture, computer, machine equipment, etc. These also include the collateral which the bank has repossessed from the borrowers in default. So basically, the component of loans and advances in the total asset of the commercial bank is 5.42% during the year 2015. Here you have basically the balance sheet of a commercial bank. So basically, this is our 18th unit, which we have discussed about the bank, and from where a particular bank get the sources of fund and how they can show it to in their balance sheet.
मैं दुखी हो गया, चिप्स खाने का मन नहीं होता, बोर हो गई चिप्स खा खा के।
So basically our next unit is non-performing asset. In the non-performing asset, basically we need to discuss about the objectives, introduction, meaning and definition, classification of non-performing asset, reasons for growing non-performing asset, provisions for non-performing assets, suggestions to reduce non-performing assets. Then we need to discuss about non-performing asset recovery mechanism. So basically if we talk about the objectives, we need to explain the meaning of non-performing asset, then we need to classify the non-performing asset, identify various reasons that are responsible for the growth of non-performing assets. Then we need to provide suggestions to reduce non-performing assets and describe the various provisions that are available for non-performing assets, and also analyze the non-performing asset recovery mechanism. So basically, in the meaning and definition, banks play a very useful and dynamic role in the economic life of every modern state. Basically, bankers are the custodian and distributors of a liquid capital of the country, and these are the most important function of the banking system is to mobilize the savings of the people by accepting deposit from the public. So the banker becomes the trustee of the surplus balances of the public, and the non-performing asset concept is restricted to loans, advances, and investment. So as long as an asset generate the income that is expected from it and does not disclose any unusual risk other than normal commercial risk, it is treated as performing asset. And on the other hand, when it fails to generate the expected income, it becomes a non performing asset. So basically, a NPA is a advance where payment of interest or repayment of installment on principal or both remains unpaid for a particular of 2 quarters or more if they have become past due. An amount under any of the credit facilities to be treated as past due when it remains unpaid for 30 days beyond the due date. And in the present time, there is a major threat of banking sector in prevalence of non-performing assets, because non-performing asset problem is one of the major and most alarming problem that have shaken the entire banking industry in India like a earthquake. So what is the meaning of NPA? Basically, the performing asset is an advance which generates income to the bank by way of interest and other charges. A non-performing asset in the banking sector may be referred to an asset not contributing to the income of the bank or which does not generate income of the bank. So, in other words, an advance account which ceases to yield income is a non performing asset. If the customer does not repay principal amount and interest for a certain period of time, then such loans becomes non performing asset. And in the narrow sense, a non performing asset may be defined as an asset which does not directly contribute to the corporate profit or yield any positive return. So now if we talk about the definition of non-performing asset. So basically a non-performing asset was defined as a credit facility in respect of which the interest and or installment of principal has remained past due or the specified period of time. So as per the definition, as per Narsimham Committee, basically the Narsimham Committee clearly defined that an asset may be treated as non-performing asset if interest or installment of principal or both remain unpaid for a period of more than 180 days. And with effect from March 2004, default status is given to a borrower account if dues are not paid for a period of 90 days. Here we have a different definitions from different norms or guidelines, and we have a definition from Surfacai Act 2002 also. Surfacai Act is the act that says the securitization in reconstruction of financial asset and enforcement of security and Interest Act 2002, it defined non-performing asset as an asset or account of a borrower which has been classified by a bank or financial institution as a substandard, doubtful, or loss asset in accordance with the direction or guidelines that are relating to asset classification that will be issued by the RBI. So basically, non-performing asset was defined as a credit facility in respect of which the interest or installment of principal has remained past due for a specified period of a particular time. So like this, in the year ending, we have that will be the March 31st, and we have the specified periods. Like in 1993, we have 4 quarters, 94 3 quarters, 95 onwards 2 quarter, 2001 180 days, then 2004 90 days. So basically, an amount that is due under any credit facility is treated as past due when it has not been paid within 30 days from the date. And due to the improvement in the payment and settlement system, recovery climate, upgradation of technology in the banking system, it was decided to dispense with past due concept with effect from 31st March 2001. So now we have a term called out of order status. So basically, if the outstanding balance remain continuously in excess of a sanction limit drawing power, that will be known as out of order status. Next one is overdue. When the amount due to the bank under any credit facility is overdue if it is not paid on the due date that will be fixed by the bank. Then due date, it is the date when the date is fixed or stipulated in the loan, that is sanction letter, or for repayment of loan installment or interest. Then we have cash credit and over credit. Cash credit or overdraft. Basically, cash credit or overdraft account is treated as NPA if the account is not out of the order for 2 quarters or more on the date of balance sheet. Then we have bill purchased or discounted. So bill which remain overdue and are unpaid for a period of 2 quarters or more from the due date, that will be treated as NPA on the date of balance sheet. Next one is classification of non-performing asset. We have three classification. One is substandard asset, doubtful asset, and loss asset. We have the asset. One is performing asset, one is a non-performing asset, and per non-performing classified into three. One is a standard asset. Basically, if we are talking about standard performing, we can also call it as a performing asset. It generate continuous income and repayment as and when they fall due. So such asset carry a normal risk and are not NPA in the real sense, and there is no special provision is required for a standard asset. Then we have the substandard asset. Substandard asset was one which was classified as non-performing asset for a period not exceeding 2 years with effect from 31st March 2001. So a substandard asset is one which has remained non-performing asset for a period less than or equal to 18 months. So in that such cases, the current net worth of the borrower guarantor or the current market value of the security charge is not enough to ensure recovery of the due of the banks in full. Then we have the doubtful asset, that before 31st March 2001, a doubtful asset was one which remained NPA for a period exceeding 2 years with effect from 31st March 2001. An asset is to be classified as doubtful if it has remained non-performing asset for a period exceeding 18 months. Then we have the loss asset. A loss asset is one where loss has been identified by the bank or internal or external auditor or the RBI inspection about the amount has not been written off wholly. So like this, we have the types of NPAs that will be broadly divided into two things. One is gross NPA and one is net. Gross consists the sum of total of all loans asset that are classified as NPA as per the RBI guideline as on balance sheet date. And the gross NPA reflects the quality of the loan made by banks, and it also consists of all the non-standard assets like substandard, doubtful or loss asset. And then we have the net NPA. Net NPA basically are those type of NPA in which the bank has deducted the provision regarding NPA, and the net NPA shows the actual burden of the bank. So like this, we have the gross advances and non-performing asset of scheduled commercial banks. You can see these tables. Then we have some guidelines basically for the classification of respect. So basically, high value account bank should establish appropriate internal system to eliminate the tendency to delay or postpone the identification of NPA. Then the classification of an asset as NPA should be based on record of recovery. Then the bank should ensure that the drawing in the working capital account are covered by adequacy of current asset, and the current asset are first apportioned apportioned in times of distress, and the asset classification of accounts under consortium should be based on the record of recovery of the individual member bank. So basically, in respect of advances guaranteed or granted for agriculture purposes where interest and or installment of principal remain unpaid after it has become overdue or for two harvest season, but for a period not exceeding 2.5 years, such as advance should be treated as NPA. Then here we have the reasons for growing non-performing asset. We have some external factors like failure of the activity, willful defaults, natural calamities, unhealthy competition, industrial sickness, then lack of demand, ineffective recovery tribunal, recessionary market trends. Then we have government policy for financing priority sector. Then we have some internal factors like defective lending process, mismanagement and diversion of funds, poor credit appraisal system, improper selection of borrower and activities. Then we have non-compliance of section terms and condition, unrealistic repayment schedule. Then we have lack of interbank coordination, absence of regular industrial visits, lack of proper pre-appraisal and follow-up. Then we have inappropriate technology and improper SWOT analysis. Then we have some provisions for non-performing asset, like we need to check the loss asset, doubtful asset and substandard assets and the standard assets also. So we need to make the floating provisions for it. So basically, the banks make a floating provision over and above the specific provision that are made in respect of accounts identified as non-performing assets, and the floating provisions wherever available could be set off against provisions required to be made as per above stated provisioning guidelines. 7.12. Here you can see the types of asset and its provision. For the standard asset, you can see that 0.25% of all types of standard advances. Then we have substandard asset, 10% of all type of standard advances. Then we have the doubtful asset up to 1 year, 1 to 3 years, more than 3 years. Then 100% of unsecured advances and 20% of secured advances. Then 100% of unsecured advances and 30% of secured advances. Then 100% of unsecured advances and 100% of secured advances. Then we have the loss asset, that when 100% of unsecured advances and 100% of secured advances. We have some suggestions to reduce non-performing assets, like careful selection of borrowers and activities. Then we have the systematic post-sanction follow-up. Then we have the proactive steps by banks. Then we can use of local newspapers, keep in touch with person who is particular person trading with the borrower. Then escape from prompt repayments, establishment of recovery cell, services of credit investigation and information agencies. Then legislative changes, asset reconstruction fund, increase the role of branch managers. Then we have the non-performing asset recovery mechanism like preventive management, first one, and it consists of the redesigning unpaid loan installments, then know your customer, credit assessment and risk management mechanism, then recovery camps, then we have the watch list, willful defaulters, then early warning signals, that one also called as EWS, then rehabilitation packages, then Deposit Insurance and Credit Guarantee Corporation of India, that will be called as DICGC, then corporate debt reconstruction, asset reconstruction companies, legal actions for recovery we need to take. Then we have the curative management. It consists of compromise settlement scheme, lok adalats, debt recovery tribunals. Then we have the Surfacai Act, that will be also the full form of Surfacai Act 2002 will be securitization and reconstruction of financial asset and enforcement of security interest act. So basically these are the terms we need to know about the which we need to know about this particular things. So this is our block 5 that we have read out today, and the subject of our corporate accounting syllabus will end here. It consists of 19 units and 5 blocks. You can read these particular things at your home and practice the numerical questions as well. So basically, thank you so much.